And we've got the second market master for the morning joining us, Navneet Munot, the CIO of State SBI Mutual Fund, joins us on the show. Navneet, good morning. Thank you very much for dropping in our studio.
My pleasure.
Well, first up, what's the sense of the texture of the market itself? Some experts have been telling us this has become a sell on rallies market. Would you say that the upside is capped for now?
So if you're trading for next few days or few weeks, maybe, but structurally I don't think so. We're going to get impacted by what's happening in Greece, and then the situation is turning every few hours. We really don't know. Of course, the events in China, but otherwise I think, and then the corporate results are unlikely to be great this quarter. But overall, I think if you look beyond the quarter, I still think that market has upside. It may be in a consolidation zone for a couple of months, but I think beyond that, there could be a good upside for a long-term investor.
So in 2015 itself, you expect the markets could give you much better returns than 8,500?
I think so.
Okay. Navneet, hi. Morning. I just want to get one plate up on the screen. Your returns that you've seen in your SBI small and mid-cap fund, which has been substantial. So in the last 1 year, the returns have been about 60%. In 3 years, the returns have been about 45%. And if you had invested 5 years back, you would have got a return of almost 25% on the SBI small and mid-cap fund. Is that still the place to be, Navneet? I mean, will you still have a lot of returns to be made over the next couple of years in small and mid caps?
So last 1.5 years, I think most of the small and mid caps were quite beaten down a year and a half back, and of course that whole segment has done well. But even the large cap funds have done substantially better than the benchmark. Of course, the benchmark has done well in 1.5 years. Going forward, if I take a slightly longer term view, let's say 3 to 5 year view, I think there are 3 or 4 things that are structurally happening in the economy. One is, I think, the government's focus on ease of doing business, I think, which will change a lot of things. The technology enablers that you are getting today, that building a brand probably takes much shorter a period than probably what traditionally has been. The improvement in the whole logistics industry, and you are going to get GST, and you put all the fall in the factors, cost of production. So rentals are going down, the wages growth, now it's easier to hire people, commodity prices are going to go down, interest costs will be down, access to capital would be better. When you put all these things together, I think there are going to be different winners in the next couple of years than what we have seen in last several years. And I think any fund manager, any investor who's got an ability to identify those kind of winners can do substantially better than the market. Having said that, I think even the broad market is likely to do well, as we discussed earlier, but I think a stock picker can do substantially better, and we have shown in some of our funds.
But who are these new winners likely to be? Give us an idea of what kind of stocks one should be watching out for.
So you've seen in history, if I don't know what analogy I can give, maybe it's like say something like 91, if you go back and see what was there in Sensex. Yeah, and look at those companies, the large companies which are doing very well in terms of the prominence within the economy and the market and the overall representation in the market cap weight. And in the next 10 years, because there was significant disruption in the economy, when you opened up, you globalized, and then lots of new entrepreneurs came to the market. I think something similar is happening now in the economy. As I mentioned about the ease of doing business, obviously lots of businesses which could not get scale may get scale now. Technology is changing a lot of things. So let's say we have seen in several consumer and retail businesses, we have seen that in some of the other businesses. Few years back, who could have thought that a beverage company from Baroda, which nobody would have heard of till few quarters back, would come to the market with a 1,500 crore market cap. The front page Times of India gives an ad of products like honey, custard. So there is a new aspirational consumer. I think when you move from $1,500 to $3,000 per capita, the discretionary spend, and there are going to be several new winners. So I think it's a big challenge for the existing incumbents to really, combat against these new players who can really threaten lots of businesses. The disruption which is happening in several businesses.
You're talking about a higher consumption economy, if I get you right.
Not necessarily. I think the change within that consumption, because when you move from 1,500 to 3,000, you see a J curve in some of the niche categories. But broadly, I think as an economy, I think will be more investment led. I think the growth would be more driven by the investments. Otherwise, we'll again get into the macro challenges that we had till 2 years back. So we have to get the mix right, and I think investment is going to play a bigger role. And that's why even the whole industrial space look quite interesting.
In the auto ancillary space, you've picked up some excellent stocks. MRF, a stock that has gone from 10,000 to 35,000 in 2 years. Something like Ramakrishna Forgings, not spoken about much, but a very well-performing stock. Would you continue to back these names, or are there any fresh areas in auto ancillaries where you see potential?
So overall in the auto ancillary, not only in this fund, but even otherwise as a house, we have been significantly overweight. Even in our large cap funds, I think several of the stocks have done pretty well. Even going forward, we remain positive on the sector. Again, I would make the same point. I think companies who are building some competitive advantage, companies that are focusing on right capital allocation, companies that are run by the right management, I think they will do well. Whether the size of opportunity is very significant.
I must say, your small and mid-cap fund, the holdings are interesting. And some of them are clear multi-baggers. Hawkins Cookers, Ramakrishna Forgings, of course, Westlife Development, the McDonald's guys. Will the next big small guy be from consumption, or will it be something from digital? Will it be the digital market space?
I think across the board, so as I mentioned, even in the whole industrial space, because I think the next leg of the growth in the economy would be driven by the investment revival. This would first be driven by the government spending, both the
beleaguered companies. What will you pick from them?
No, so I think avoid. So as a house, what has done well for us last couple of years is staying with companies that have higher operating leverage and avoid those companies that have higher financial leverage. I think several of them are in deep trouble, and we don't perceive that there would be much equity value left. So I think we didn't try to do that bottom fishing in that area, and then stayed with good companies that have the operating leverage.
Are there any power companies with low financial leverage? Are there any road builders with low financial leverage?
In India, you have a choice of several stocks. You don't have to really buy those ones only. And I think even in the overall, as I mentioned, industrials, I think in the capital goods, in the engineering, in construction, even, cement could be another play. I think across all these, you can identify companies that don't have much leverage in the book. And I think they would be a bigger beneficiary of the revival in the industrial cycle compared to those who are heavily indebted. Of course, maybe from a price point, there would be some stocks that will do well, but that's a tough game to play.
When will cement turn? We've been waiting every quarter. Experts tell us cement is going to turn, or it will lead the growth.
Yeah, it's a more longer term call. Of course, in the last couple of months, it has surprised negatively. But we have seen, I think, the government spending that people were expecting last quarter hasn't happened. I think it will start with the housing for all, with the smart cities, with the overall revival in the investments. I think whether it's the roads, I think the contracts are being given. I think it's just a matter of time when we'll see a revival. Most of these companies don't have leverage, and that's a positive point. They are running at 50-60% capacity, so you have a substantial operating leverage, and that's what we are playing there.
Okay. A couple of the stocks in your portfolio, one is Hawkins Cookers, as Lata was pointing out. That one has actually fallen almost 30% this year. So some of these expensive stocks are actually getting sold into now. How would you react to that? Do you still back them because they're good quality management, great stories, or now do you start to become a bit concerned about valuation?
In last couple of years, what has really paid off is basically staying with the quality. And when I say quality, I think those who have a more fortified balance sheet, I think that the capital allocation decisions have been right, visibility of cash flows and not having excessive leverage. Growth is scarce globally. Growth is quite scarce. Profitable growth is very scarce. And that's why any company where you see growth and a profitable growth and without any kind of dilution, I think is likely to command a premium. That premium, of course, has gone to probably another extreme. In some of these cases, without talking of specific stocks, in some of these cases, we would look beyond a quarter or two, and we have taken a structural call in our mid and small caps. I think we look beyond 3 years, beyond 5 years, and look for a sustainable growth. But by and large, I think as growth becomes more dispersed, maybe another couple of quarters where you have a situation that several sectors, several stocks are participating in the economic recovery, the growth premium is likely to shrink. And that's why you need to expand the investment universe. But probably we are not there yet. Maybe somewhere we are in the middle of the cycle where you need to probably balance your portfolio with maybe paying a little bit of premium for that growth and quality, and maybe looking for those companies where, the whole cyclical recovery will lift all the boats which are probably not looking in a great shape today.
Another stock that you have picked out, which is doing exceptionally well in your portfolio, is Relaxo Footwear. That one, I think this year, if we can pull up a one-year chart, it's gone up almost about 80-odd%, so almost double this year itself. Are you noticing any pickup in the consumption trends as a whole?
So as I mentioned that there would be new, I also expect that there are going to be large number of new companies that will come to the market in next several years. And as the overall consumption economy becomes bigger, you have a new aspirational consumer, you have probably the overall urban consumption particularly. I think I have a strong view that CPI is going to get crushed in next several years, driven by several factors. You have a government and a Reserve Bank which is determined and showing not only the intent but through the actions that they are going to keep inflation under check. And when you have the rising income with CPI not going up, I think we are giving more power, to the consumers in terms of the consumption power. And if the overall commodity prices remain low, so let's say the savings that you have from the oil and all, I think will get bit towards the saving and bit towards the higher consumption. And there are going to be lots of interesting plays there. But definitely they are not, the existing ones, when you see in the market, wherever you have that visibility, they are not cheap.
That's true. There will be several people who will still, out of safety or low risk appetite, go into the ETFs. What can the Sensex return or the Nifty return in 12 months, in 24 months?
I think over the next 3 or 5 years, we will see a mean reversion in the corporate earnings in India. If the historically 20 years growth has been 14-15%, last 5 years is 8%, we are going to get back to probably 15% in next 3 to 5 years. Looking at where the valuations are today, I think market can expect the earnings to get reflected in the overall stock price appreciation. So I would suggest maybe I think 14 or 15% growth for next couple of years. But it won't be linear. I don't know whether they will get front-loaded in next 1 year or whether they will get a little back-ended in the 3rd or 4th year.
But this 15%
post-taxes is still okay.
No, but
it's very nice. I think what people are not looking at is that the relative opportunity which is there. So I think after what we have seen in the real estate market, in the gold, and I have a strong belief, I think rates are going to go down. On a relative basis, tax adjusted, I think equity returns are going to be extremely attractive for next several years.
But this 15% growth, it pales in comparison to the 60% that your small and mid-cap fund has returned. So for the next 1 year, what is your prognosis on how much small and mid-caps can give you return?
That depends on your stock picks, of course. And as I mentioned that 1.5 years back, we used to think that, so in our house, we run two distinct philosophy, a relative return philosophy and an absolute return. Absolute in a long only context where we look for 3 to 5 years absolute returns that we can make in a stock regardless of how the market moves. And there we look at competitive advantage, the return on equity and the growth potential. And 1.5 years back we used to think that looking at several of these companies, they were looking so cheap that maybe the stocks can easily double in 2 and 3 years. Of course they have done better than our expectations. Today of course you have to probably elongate that period. So maybe they will double in 4 years. So I think maybe 15, 17%, 18% can still be expected.
Okay. Did you buy Nestle at its distress hour?
Can't discuss individual stocks, but I remain confident that I think the companies that have built a great franchise, the companies that are run by the right management, I think India is still probably a long way to go in terms of the overall growth potential.
Okay. How do you shut out the noise from the global scene? Will that affect, can there be huge problems for India in 2015 or FY16?
So there may be problems, but I think they will probably offer a great opportunity to India. So Greece is like less than 1% of our population, very small. And on a lighter note, Lata, whenever you don't understand something or you are not able to interpret something, you say that this is Greek to me. Okay. And in last few days, now I know why people say that. And I think some of these, whether what's happening in Greece or the bull in a China shop, what we have seen in the Chinese market in last few weeks, I think they offer a great entry opportunity. One structural thing that we are seeing now. In last couple of years, we were extremely vulnerable to the global flows because the domestic investors were selling. I think it's changing. It's changing in a very big way. And I think structurally for next 3 to 5 years, I think the participation of domestic investors will keep increasing. And to that extent, I think we'll be able to cushion the impact that we have, which is induced by the volatility in the global markets and the actions that we see from the foreign investors.
You're the second big fund manager telling us this in the last 1 hour. We had Manish Gundwani telling us exactly that he's expecting a secular force of domestic money
Absolutely.
to keep coming in. All right, Navneet Munot, it was a pleasure speaking with you. Thank you.